Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 219th VideoCast podcast for the week ending December 28th, 2023. We've got some pictures, then we've got a lot of media, a lot of great overview for the roadmap for 2024, some Ask Me Anything questions, and then we'll get you out of here today. I'll be on Fox Business today at 3 p.m. with the great Kelly O'Grady. So tune into that if you're free. And I'm going to be covering, a little teaser. We're going to do a little Cooper Standard today. So excited about that. This is from Friday. I was on the Clayman Countdown Fox Business with Liz Clayman. It's always so amazing to see her and so much fun to be on set with her. She's just fantastic. And by the way, she gave me my first break on TV. So always grateful to Liz, and Ellie Terrett, her producer at the time, got me started, which was just unbelievable. Some back view here. A lot of people like to see. This is behind the scenes in the green room. That's the kitchen that they have for guests and hosts and that type of thing. You can see Fox News on the coffee maker there. This is the Christmas tree outside the building. The News Corp and Fox building never gets old. The Nutcracker Christmas spirit. It's one of the happiest places on earth. This was before my segment. Liz is getting ready with her notes. And then the family came in. We did a little bit of Christmas spirit before Christmas. That's us in a taxi cab. We met the nicest taxi cab driver. We were talking about karma for, it was so funny. We were talking about karma for like 10 minutes. And he's like, I really like your philosophy. I live by karma. And then this guy nicks his taxi cab mirror, and he opens the window and he starts giving him the finger and cursing at him all every which way from Sunday. And I was like, so you were saying about karma? And then we had a nice dinner. Of course, we always do steak. We didn't have to go to Brooklyn this time. This is Ben and Jack's. The chef came from Peter Luger's. You can get it all right on the island. And the kids had a blast with that. This was Rockefeller Center and the Rockefeller Center tree. This was the dessert, which is just as good at Luger's. Ben & Jack's is just as good as Luger's. The difference is you don't have to go to Brooklyn, but when in Brooklyn, you definitely got to go to Luger's. This is Caitlin with the kids in front of the tree at Rockefeller Center. This is Caitlin and I in front of St. Patrick's Cathedral. That's where we were married over 16 years ago. So that was really nice to get that photo in while we were doing that. And this, I was doing obviously some channel checks. There's the North Face flagship on 5th Avenue was booming. I mean, you can't walk down the street. It's almost like everyone's wearing North Face. This is the girls with some of the North Face mannequins. This is out in front of the store. This is from the top level looking down. So I'm doing my channel checks. Then we went to Vans, the other part of VF Corp, the troubled child. And I thought this was cool. They had these Vans where you can upload any photo. You could put a photo of yourself on the sneaker and get them custom. So we'll see how that goes. Then these were the new Vans. And I was talking to the sales lady. She said, Wiz Khalifa and Travis Scott always wear them, and that's been a big thing. We'll see. But talking with the other salesperson, it's still a lot of, I'm like, who's buying these? And it's still a lot of Europeans and South Americans. They're so popular outside the US. They just haven't found the right click for the US, but they will with the new CEO and everything else. And then Vans will be humming just like North Face and like it was in the US several years back. This is Christmas Day, a little bit of our Christmas tree and the elf on the shelves. This was Fox on Monday. I came in to do, but it was Ash Webster was doing it remote, so I was in a pod in the studio. This is the main bullpen at Fox News on 6th Avenue, which is pretty cool to be around all the action. This is the lobby. You can see, and then this is the tree outside, and this is what the pod looks like. So you look into this camera here, and you can see the show running here, and that's me taking a picture of everything, and then I'm sitting back here. So that's pretty cool, and that's the countdown clock to when you're on. You can see I organized these pictures very well. They absolutely have no rhyme or reason. This was Christmas dinner. So Caitlin just did a beautiful job of decorating everything. And that was that. And then Yahoo Finance on Tuesday. And that's Brian Sazi and Brad Smith. So that was fun. We're going to get into all those. That's their new studios. That's a green room they have next to the studio. That's from outside the studio in the bullpen where all the people sit, kind of like you saw in Fox. So that's just a few pictures. See you at 3. Here's the quote of the week. Everyone has the brain power to make money in stocks. Not everyone has the stomach. If you're susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds altogether. And my goodness, we had so many stocks this year that in October, people were like, what are we doing? And here we are at the end of the year, rocking and rolling, unbelievable. And that's the name of the game when you know what you own. And that's what we try to teach on these weekly VideoCast podcasts is price is what you pay, value is what you get. And when you understand the value, you don't get shaken out by short-term noise. The article of the week is The Last Shall Be First Stock Market and Sentiment Results. We're going to go through segment by segment. First and foremost, I want to thank Chris Kang, as well as Karen So and Arabile Gumede for having me on CNBC London, which was pretty exciting. So we have CNBC US, CNBC London does all of Europe, EMEA, then obviously CNBC Indonesia and CNBC Asia. But this was a fantastic interview. We're going to, this was all about the overview for 2024. We're going to listen now.
Well, let's get on over to Thomas Hayes then, who's the chairman and managing member at Great Hill Capital. Thomas, good morning to you then, and thank you so much for joining us. I mean, can we carry on this momentum? We're seeing this market just continue to rally towards the end of the year, and really just the gains we've seen this year may have surprised quite a few, but can that carry forward to next year? Not much really changes other than sentiment around interest rates and inflation, surely?
Yeah, well, thanks for having me, Arabile. This is what a year-end chase looks like when 65% of managers are behind their benchmarks. They certainly ran the Grinch out of town this year. But we have to keep in mind, certainly the recency bias. We have come a long way in a short period of time in the last couple of months. But if you look back and zoom out a little bit, over the last 2 years since 2021, the returns to the S&P 500 are basically zero. We're just now breaking out to new highs, and it's very tough to short new highs. There is kind of a consensus that after moving so far so fast, we have to have a correction of 5 or 10% in the first quarter. I wouldn't get too cute with it because the underlying economics look pretty well. The key is going to be finding the opportunities under the surface versus chasing the indices.
Yeah, so what makes sense then on that interest rate front in order to keep this market sort of bubbling in the right direction, or in this direction, shall we call it then, right? I mean, what sort of interest rate environment are we looking at? The kind of tone as well that comes out of the Fed. What clear messages do they need to send to get the market still moving?
Yeah, well, the Fed is still restrictive. Their dot plot is showing, 3 cuts in 2024. The market, the Fed funds future, is showing 6 cuts. So there's a pretty wide spread there. And if you look at the Fed is still extremely restrictive. When you look at the Fed funds rate, 525 to 550 relative to core inflation, there's over a 200 basis point spread. So that's still very, very restrictive. I think as they see the disinflation continue to kick in, they will move ahead with the cuts. The market is going to like that. And what's interesting in the US is everyone was looking for a recession in 2023 that had already happened in 2022. The first 2 quarters of 2022, we did have a technical recession with negative GDP. So CEOs went in the year of efficiency in 2023, cutting costs, running lean operations. So I think the story for 2024 that no one's looking at, besides earnings growth of 12%, is going to be margin expansion, margin reacceleration of 60, 70 basis points, which no one's prepared for. So the earnings might actually be a little light, even if the multiple is pretty expansive at 20 times forward. there are tremendous opportunities under the surface, relative value in small and mid-cap space, which is only trading at 14 times forward earnings.
Thomas, can we talk about the relevance of positioning and sentiment here? Because if we take a look at your chart as to the extent of the rally, we know it's aggressive November, December, but still we are coming off lows. So what's the relevance here of that sentiment and positioning as we enter 2024?
Yeah, Karen, that's a great point. In the U.S., Bank of America does a global fund manager survey every month. And what we actually notice is that when asked about improving growth, yes, sentiment is turning up, but it's barely coming off the mat. It actually resembles the type of sentiment we saw in the summer of 2020, just coming off the COVID lows, and in the summer of 2009, just coming off the great financial crisis lows. So people are not exuberant at the institutional level. That's number one. Number two, in terms of the amount of risk that they're taking in their portfolios, again, it's looking just like summertime 2020 and summertime 2009. So there's a lot of runway ahead. And that's why we say, yes, you may get a little consolidation and a little volatility in the first quarter, but I wouldn't get too cute with it. There's still tremendous amount of opportunity, particularly outside the Magnificent Seven. And if you look at the presidential election years in the US, which 2024 is one, on average since 1928, the market's up 11.28%. And in years where a sitting president is running for re-election, the market's up 13%. So we are looking for high single digit, low double digit in the indices and more opportunities under the surface.
Thomas, we may have a playbook for this election as well, given it could be a repeat of what we've seen before. To your point about underperformance, 72% of the S&P 500 stocks underperformed the index this year. That was a record, according to data from Apollo Group. What happens if we have a very noisy election cycle again? Does that mean the rest of these stocks get scooped up, and thanks to the Fed as well? Or do we actually see a return to these thematics, the long-term EV story, the AI disruption story, the tech theory? You know, what do we see in terms of the market focus?
I think we're going to move to value. I mean, the biggest risk of the election is that you get one party wins the executive, Congress, and the Senate, and they have absolute power. In those environments is when you get underperformance in the stock market prospectively. I don't think that's going to happen. As long as one party wins one of the branches and there's some level of blocking or gridlock, the market will do well. As far as if you look at the general indices and expectations of high single digit to low double digit gains, that means the Magnificent Seven that have driven the boat in 2023 are going to do less well in 2024. And to your point, the 72% that have underperformed, a lot of it is actual value stocks are going to continue to begin to participate like we've seen in the last 2 months and really outperform.
Thomas, can I ask you about this OpenAI story from overnight? OpenAI and Microsoft being sued by the New York Times over the use of their data. This is not just a story that seems to touch media companies. We've got AI models that have been trained on all sorts of data sets. Is this a potential hurdle to the AI story?
Yeah, there's no question. And I think what people fail to point out is AI has been around for a long time. Amazon has been recommending books to you every time you place an order since for the last 2 decades. I think what came out in 2023 was an interface where the public could see the power of AI in ChatGPT, and that's what kind of drove the momentum in the stock market for AI stocks. But at the end of the day, you can't steal people's work. So if you want to use them in your data sets, you're going to have to pay. And that will put a little bit of a governor on it. They'll be able to raise capital and they'll work through it. But I think in the short term, that's going to be a little bit of headwind for OpenAI and others building out large language models without paying for the data.
Thomas, let me quickly touch on treasuries then as well. I mean, we saw the 10-year treasury yield yesterday pretty much go to its lowest figure since mid-July. And just on the month figure, it's dropped 50 basis points in December after falling 53 basis points in November. That 2-month fall is the biggest since 2008. I mean, the sentiment there just feels like that's going to continue its decline. So How do you look at that going into next year? Do you stay there for at least the longer ones, the longer dated stuff, or do you perhaps bow out and look at the things like cash, going more into equities, which would pump it up even greater than it perhaps did this year?
Yeah, I think people are starting to move into the longer duration, particularly institutional demand, pension demand. You know, if you look back just to August, I mean, it seems like decades ago, it's just a few months ago, hedge fund managers were the most short long-dated treasuries than they've ever been since 2018. And if you go back to summer 2018, that was the beginning of a very large rally in the 10-year treasuries. So I think we could see some follow through, maybe a counter trend bounce here in the short term, because everyone is now betting that rates are going to continue to go down aggressively. So maybe you get a counter trend bounce to catch people off sides. But the trend is your friend. And I think that you're going to see yields continue to compress in 2024 and beyond. That is also a part of our bull story, which is going to enable a lot of companies who haven't been able to tap the capital markets to not only refinance their balance sheets, but do so at a lower rate, which is going to help earnings power. And I think that's not in a lot of the forward models as people can refinance at lower rates.
Well, may the trend be with you then, Thomas. Thank you so much for the time. Appreciated it today. Happy New Year as well. Hopefully we'll chat again in the new year. Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Now.
And we're back. And then on the Clayman Countdown on Friday, we covered Comstock Resources. We also covered biotech and the outlook. I want to thank Liz Clayman and Melanie Kapadia for having me on. We're going to listen now.
Right to the floor show, we have Cetera Investment Management CIO and Director of Research Gene Goldman and Great Hill Capital Chair Tom Hayes. Tom, it's a very resilient market, is it not? And what keeps it going in 2024, or at least till the end of this session?
Well, it looks like they ran the Grinch out of town this year, that's for sure. And if past is any prologue, the next 7 days we could get on average 1.3% gains. Looking into 2024, the average gain for a presidential year is not going to be quite as good as this year, but up 11.28% since 1928. So there's a lot to do, but we have come a long way very, very quickly. So we may see some consolidation in January and February.
I mean, it's just, it defies the odds here, on track for more than 8 weeks of gains in a row. I just look at this and I think to myself, Gene, wow, how much further does this go? We know that bulls get tired. We know they have to take a seat on the bench at certain points, but without any such catalyst, at least at the moment, and I'm surprised that we're not getting a catalyst, what's happening in the Middle East, specifically in shipping. Right. All the shipping lanes through the Red Sea have to be diverted due to safety reasons. That is 12% of global shipping that goes through that route. Why is that not some type of black swan or even a black duck or a black parakeet?
Hey, Liz, everyone's...
Go ahead.
Oh, sorry. Hey, everyone. So everyone's focused on trying to find something that's going to be Grinch related for Christmas, but we don't see anything. I mean, I know this is definitely an overhang. Clearly, costs are going to rise a bit, especially you're seeing shipping costs rise. But for us, we're saying that 2024 is going to be almost like a Goldilocks to the max scenario. The Dow is hitting a record high. Unemployment rate's been below 4% for 22 months. Inflation's rolling over. Gas prices are now 1.5-year lows. All good stuff. We're terming 2024 as an opportunistic bull market. Yes, some of the gains from 2024 maybe have gotten pulled into the last month and a half or so. But look at small cap. I loved your graphic earlier about Russell 2000 having a great week. Small cap, mid caps are looking attractive. And those are the areas that we're going to be really focusing on. Plus value next year. Opportunistic bull market next year.
All right, so you don't see huge supply chain implications, at least from what's going on in this risk scenario of the Middle East. All right, Tom, if Gene is right, where do you like these markets at the moment, if not in some of the large caps like Nike, Walt Disney, Boeing, which are the laggards on the Dow at the moment?
Well, Gene is right. Small and mid caps trading around 14 times next year's earnings. Large caps trading about 20 times. So that's where we want to focus. We've got a special name for you. You know I like turnarounds. I gave you Vornado, your audience, in April. We just sold that at a double in about 8 months. We've got another turnaround. Comstock Resources. Jerry Jones owns 65% of the stock. He says his holdings in this business are worth more than the Dallas Cowboys. This is really interesting because The proven reserves, PV10, are worth $15.5 billion.
This is energy.
The stock is trading at $5 billion enterprise value. So if they liquidated it today, this is all natural gas in Haynesville, northern Louisiana, East Texas, you would have a triple.
Yeah, but it has a 174% gain year over year. Why am I buying it at such a high point?
This thing is depressed. This has come off of 20. It's down to about $8 or $9 right now. We think over the next 12 to 24 months, the demand is going to continue to increase. They have shipping through the Gulf, and we want to bet alongside. Jerry Jones's basis in the 65% is around $7. You can get in pari passu with him and ride the wave.
Well, his Cowboys did not look so good the other day. Gene, let's not ignore what's going on in bond land, and I'm talking treasuries. The markets just, I want to say in the last hour, all turned red. They're back in the green at the moment, not by much, though. When yields were continuing to rise, yesterday, Andy Brenner of Nat Alliance said this about the 10-year yield, because we were saying, did you miss that high there to buy at a decent yield for the 10-year? Here's what he said.
And we have next week, we have $155 billion of treasuries. In January, we're going to have a huge amount of treasuries. So I would look to buy 10 years back behind 4%. In fact, I might even wait to 430 to 434.
And you think that'll happen January, February?
I think that will happen the middle of January. I think you want to get long before the next Fed meeting on January 31st.
Gene, I'm guessing you disagree.
I definitely disagree. He's right in the sense that we have a lot of treasury supply coming to the market. Definitely. But think about it. We have a huge amount of demand coming in. We've only had 10 weeks this year where mutual fund bond flow outflows we're seeing. Lots of demand on bond funds. Second of all, you also have the fact that inflation, bond yields are well above inflation. Third of all, you have that this is an election year next year. Nothing's going to change around the budget deficit. We are going to see a lot of opportunities in bonds. So what do you do with bonds? Where are we buying bonds? We've been increasing our duration almost every quarter to take advantage of yields. We envision yields, the 10-year Treasury yield next year, maybe about 3.9 to 3.5%. If we have a recession in the second half of the year, which we don't think so, but if there is recession, we can see yields going below 3.5 on the 10-year. We are finding opportunities. The scary area, though, is high yield. High yield will probably do okay next year, but it's ignoring the fact that defaults are going to pick up.
Well, at the moment, we have borrowing costs still pretty high, and for growing companies, Tom, and I'm thinking biotech.
Yeah.
Biotech is growing. They need a lot of capital to develop these new drugs. Right. Who knows if that's going to be a problem for them, but you say buy the biotech.
Yeah, the whole theme for 2024, and the biotech, the XBI index, has done absolutely nothing for a year. It's been dead money. We've been waiting and waiting. All we had to do was wait for Chair Powell to get out of the way, and the inflation number this morning confirmed that he's going to get out of the way. And to what Gene says, as rates go down, biotech goes up, they can raise capital. So we're going to see more deals, just like we saw with Bristol Myers this morning. We're going to see more drug approvals, and the big pharma have unlimited cash, but they have no growth. They have patent cliffs. They have to buy the growth, and these biotech companies are trading at historic low valuations.
Well, I have historic respect for you and Gene for coming in on this Friday before the holiday. Thank you both so very much.
Thank you.
Gene and Tom, and have a healthy, happy one. Thank you so much.
Merry Christmas.
You too.
Thank you.
And we're back. And then with Ashley Webster, I went into detail on PayPal and was also planned to speak to Generac as well as the 2024 outlook. So we're going to listen here.
Welcome. Good afternoon, everyone. Santa Claus still in town. That's the good news as the markets continue to rally heading into the final week of 2023. Sentiment among fund managers a lot more bullish following record pessimism earlier this year. That's gone out the window. Joining me now, Great Hill Capital Chairman Thomas Hayes. Thomas, great to have you here. The biggest bears on the street discovering reasons, hey, to load up heading into 2024. But is it too little, too late? Let's begin there.
Well, this is what a chase looks like when 65% of managers are behind their benchmark. The common denominator right now is we've come a long way in a short period of time, and everyone's calling for a correction or a consolidation in January and February. I wouldn't get too cute about that, Ashley, because it's very hard to short new highs, number one. And number two, we've actually had zero gains in the S&P 500 for the last 2 years since 2021. So it's just starting to come out of that long-term consolidation.
You know, almost 90% of the S&P 500 now trading above the 50-day moving average. Is the bullish market a contrarian sell signal? Let me ask you that.
Well, there is a consensus that everyone, when there are no bulls left, what's the next step? But we do have earnings growth of 12% next year for sure. And we have a lot of positive things coming in the economy. So I think the relative value play is going to be the large caps are trading at about 20 times next year's earnings, whereas the small and mid cap stocks are trading at about 14 times. And then if you look at the presidential election year, on average since 1928, the market is up 11.28%. And when a sitting president is running for re-election, it's up about 13%. So yes, we may get some consolidation in the first quarter, but you don't want to get too pessimistic here, Ash.
No, never. Not me. What about the S&P 500? What kind of target do you have for next year? It's right at 47.72 right now.
Yeah, I think you want to be looking for a high single-digit, low double-digit. It won't be quite the same as 2023, but certainly we could see another 400 points in the S&P 500. I do think the real opportunity, though, Ash, is going to be underneath the surface. Don't just chase the indices. Don't chase what's already up. There are a tremendous amount of stocks that participated less than the Magnificent Seven this year that are going to be great opportunities in 2024 and a way to make a lot more than high single digits or low double digits.
What are you buying here? What do you like?
Well, I like one that's been left for dead. I've actually got two turnarounds for you, Ash. Both fell 85% off their recent highs. The first one is PayPal. Alex Chris is the new CEO. He came from Intuit. He ran the small business division at Intuit. Over a 12-year period, Intuit was a 35 bagger, meaning if you put in $1 million, you got 35 million. He was responsible for 50% of those revenues. He's coming to PayPal. He wants to turn this back to a growth company from a value company. And when I say value company, this stock is trading at 12 times next year's earnings. It's historically traded at 30 times. And what does he have to do that? He's got to increase the margins at Braintree. Braintree is the large enterprise processing. They have 10% of the global large enterprise processing, which is about $5 trillion. They have $500 billion of that. The margins are just starting to inflect in his first and second quarter as the new CEO. And we think that's going to be the catalyst to start re-rating the stock to a higher multiple. We think this thing has legs. It's up 23% off the recent lows. We think this can be up 50 plus in 2024 and maybe a double over the next 24 to 36 months with the new CEO.
Well, Thomas, we are already out of time, but we have PayPal, we have Generac. We hear you. You're a mine of information. Thanks so much for joining us on the show today. We really appreciate it. And by the way,
so much,
I want to give our viewers a reminder that Charles will be hosting the Becoming.
And we're back. I want to thank, obviously, Ashley Webster, Charles Payne, and also Kayla Arestivo and Nick Palazzo for having me on that. And then finally, we had Yahoo Finance on Tuesday. Want to thank Brad Smith and Brian Sazi, but also, of course, Ellie Cunningham and Alex Frangaskides for having me on. They were the producers. And we're going to listen here because this one we did get to speak about Generac and we did get to speak about the overall market. So listen in.
It's rallied heading into the final trading week of 2023, just days left, with much of the optimism being put down to the dovish tone from the Fed, indicating around 3 rate cuts in the new year. S&P and the NASDAQ have clocked in highs not seen since 2022, tracking a 9th week of consecutive gains. Our next guest predicts this upside could last for several years, and has chosen some stocks which will specifically benefit from the predicted cuts to come. Let's bring in Thomas Hayes, Great Hill Capital Chairman. Thomas, I don't even know what I'm doing for the next several years here. You're anticipating stocks, and this could permeate, and this optimism could permeate for several years. What is the main catalyst? Because it can't be AI alone.
Yeah, well, this is what it looks like when 65% of managers are behind their benchmark. So we've had this huge year-end push. We've come a long way in a short period of time, and now consensus is we must correct in January and February. I think a lot of people are positioning for a 5 or 10% correction. I think the key is to zoom out, because if you actually look, we've had 0% gains since 2021 in the S&P 500. We're now just breaking out to new highs, and it's very hard to short new highs. So it wouldn't be surprising to see some consolidation in January, February, some volatility. But I think as you look forward, there are a lot of stocks that are just starting to participate that are at very low valuations that can perform over the next couple of years.
So what's the best strategy? Somebody watching this, they're seeing a market trade at record highs. Do you pour more money into NVIDIA, even though it's up, 237% a year and trading at record valuations? Or do you sniff around some of these doggy healthcare stocks that have had terrible years this year?
I think the latter. I think you want to look at relative value. Large cap is trading at about 20 times forward, maybe now a little bit more than 20 times forward. Small and mid cap are trading around 14 times forward. So that's where you're going to find the real value and the real opportunities. So I do think that, if you look at presidential years, the average since 1928 is about 11.28%. With a sitting president running for re-election, it's about 13%. So those companies that make up the heaviest weights will probably do okay, but much less well than they did in 2023. So I think you've got to look under the surface, and I do think there's going to be tremendous amount of money made under the surface, even if the general indices are only up high single digits, low double digits in 2024.
You mentioned going into a presidential election, general election year. What amid what is anticipated to be a vitriolic campaign season that we're going to see next year, what could spook the markets? Is there anything that could throw us off course, especially given some of the concerns that we've seen geopolitically, or even where the Fed is going to perhaps have its own turnover as well going into next year, and where camps line up there?
Yeah, there's always something. I mean, we do have the geopolitical risk. We do have the Fed risk. I mean, you've got a wide spread between the Fed anticipating 3 cuts in the dot plot and the market anticipating 6 cuts. The Fed is still highly restrictive right now. If you consider where the Fed funds rate is relative to core inflation, you've got about 200 basis points of restriction. So they're going to have to close that gap. Maybe if we do see a little bit in oil, that'll help keep inflation a little bit above trend, and then they bring down rates modestly. That'll get us to a more accommodative state. But really, it's going to be a stock picker's market, and I think the real risk for the markets generally is not politics. It's if one party wins the executive, Congress, and the Senate, that's when you tend to get underperformance. As long as you have some form of blocking and gridlock, that's very, very positive for equities.
Like Brad mentioned, it could be a really volatile year because of the election. Are there certain stocks or names you think could just overcome this political rhetoric?
Yeah, there are a few that we really like, and they call me Turnaround Tom because these have really gotten hit off of the recent highs in 2021. So you've got 3 turnarounds. Number one, you got PayPal that was hit 85%. You got Generac that was hit 85%, and then you got Crown Castle that was hit 55%. All of these benefit in their own ways from rates starting to normalize. My favorite right now is PayPal, and particularly because of a new CEO catalyst with Alex Chriss. Alex came from Intuit, where he ran the small business division. He was responsible for 50% of revenues, and over a 10-year period, that stock was a 35 bagger. So this guy knows how to do acquisitions, to do accretive acquisitions, to cut costs, to drive growth, and he's going to do that in PayPal. PayPal, his initiative is to turn it from a value stock. What do I mean by that? It's now trading at 12 times next year's earnings.
Amazing to see PayPal trading at those levels.
Yeah, it historically traded at 30 times. He's going to turn it back into a growth stock, and the key thing that analysts have been very negative about why it got derated down to 12 times is Braintree is 10% of the global large enterprise processing. Think they've got Uber, they've got Ticketmaster, and the margins contracted. The size increased, but the margins contracted. That's starting to reaccelerate since Alex Chriss came in the last quarter or so. As those margins start to reaccelerate, you're going to see multiple expansion, coupled with rates lowering can help with that multiple expansion. And we think this one, despite the fact it's up 23% in the last few weeks, we think this can go up another 50% over the next 12 to 18 months.
Make Generac sound sexy, because a lot of people are wondering why you chose that that one?
Okay, so Generac has the same problem that many companies coming out of the pandemic, whether it was Intel, many others. They overstocked on the basis of not being able to get enough parts, worried demand was huge. They bought at the exact wrong time at the exact wrong price. They've brought inventories down from 2 times normal levels to normalized levels in the last 4 quarters. And the consumer often finances it. So they've been a little bit stopped out with rates going up. As rates start to come in, you're going to see more financing. And this is a covert play on the housing recovery. As rates come down, you're going to see more and more supply of houses come back on the market. Their commercial and industrial business has been doing fantastic, up 24%. They back up some of the cell towers, et cetera, data centers, et cetera. But that residential needs to come back. Now that you've got the inventories through, I think this is going to be a great play for 2024.
Turnaround, Thomas Hayes, Great Hill Capital Chairman. Good to see you and Happy New Year. Thanks for coming down.
Thanks for having me.
We appreciate it.
And we're back. And then I think now is going to be the highlight of the week. I did for the first time ever something called Twitter Spaces. A gentleman named Michael Gayed invited me on. And Michael runs an ETF called Risk On, Risk Off. It's kind of it seems like a tactical trading type of vehicle. And he also runs a newsletter called Lead Lag Research. So you can check him out on Twitter or just Google him. But we did a 53-minute interview, and he asked some really incredible questions. I thought it was a great back and forth, and it really got into the nuance about what I'm seeing around small caps, what I'm seeing about emerging markets, dollar bonds, et cetera, and why, and really drilling back and forth. Michael is historically known for having a very cautious outlook. He's more of a macro thinker. So it's good to get that compare contrast type of market view for the coming 12 to 24 months. And I think you'll get more value, not just out of hearing my outlook, but also hearing the counterpoints, and then you can draw your own conclusions. So we're going to listen in here.
Those that are coming in here, please, folks, do me a favor during this roughly 50-minute conversation. Click that top arrow at the top of the space. Share this via DM to your friends, to your colleagues, anybody and everybody that you can think of. Try to get this room as full as possible. We're going to be talking about markets and different ideas for next year. I'm excited for this conversation. Tom, I've been going through your posts. I think there's a lot of things we can touch on, so hopefully we'll have a good back and forth. As always, this will be an edited podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, and Spotify. Nearly 1 million downloads. Hopefully I'll get there by end of first quarter on Apple and Spotify. Please help me keep that momentum going. And as always, if any of you want to come up and ask questions, click that bottom left mic request button. With all that said, my name is Michael Gayed, publisher of the Lead Lag Report, as well as portfolio manager of the ATAX fund family, ATAX, Roro, and JoJo at Tidal Financial Group. Joining me there is Mr. Thomas Hayes. Tom, introduce to the audience and me more formally. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
All right. Well, thank you for having me on, Michael. This is my first Twitter Spaces, so I'm pretty excited about that, or X Spaces as it is. So I'm chairman and managing member of Great Hill Capital, which is a long-short equity strategy for accredited investors and qualified institutions. We run it in separately managed accounts. Prior to that, I was with a firm called Cornwall Capital. You may remember them from The Big Short. I worked for the gentleman that was played by Brad Pitt. He's less handsome in person, but much smarter. And then prior to that, I was at a value shop called Bedford Oak Advisors and kind of grew up in the value mafia there with the seed investors at that fund were Michael Bloomberg, Sam Zell, Gabelli was a big investor, Phil Frost, the chairman of Teva. So, you know, I kind of grew up around that mindset, and the principal was very good longtime friends with Buffett. So we'd go out to the annual meeting in Omaha every year, sometimes on Gabelli's jet, sometimes on a rented jet, but we made it out there, and it was just a life-changing experience. So I grew up in the kind of Buffett mindset, Buffett Munger mindset, and I've since adapted with my own style over the years and some of the things I like to do, which is more skewed towards turnaround, but trying to stick with high quality at the same time, which may sound like an oxymoron, but there are ways to do it. And that's basically my story.
Has it been challenging to manage a long-short strategy this year, given all these, what I would argue, are disconnects in terms of Magnificent Seven versus everything else?
Yeah. You know what? I'm glad that you put a highlight point on that. We have the optionality to go anywhere, but we're not always long short. So we'll take short bets when there's immense asymmetry to the downside for a particular instrument, sector, company, group, and we'll express that usually through long premium. So it's not in the traditional sense where we're, half our book is long equity, half our book is short, buying cheap and selling the most expensive stuff. We more kind of express our views through buying high quality businesses and growing cash flows with a large margin of safety. And when the market gets to periods that are frothy, having the long short enables us to hedge out if we want, take asymmetric short bets if we want, but predominantly we're buying high quality deep value, and we're doing it in a concentrated way. Usually we'll own anywhere from 8 to 12 companies, and then which comprises maybe 85-90% of the portfolio, and then we'll have long dated derivative overlays for some excess performance, and we take very little to no leverage on top of that.
All right, so on that high-quality, deep value side of things, does that imply that you're focused more on a particular cap part of the marketplace, more large cap, mid cap, small cap? Because I'm going to make the assumption that maybe there's more deep value names that are smaller cap, given just the lack of participation, this year on a relative basis.
Yeah, I think that's right. No, we are go anywhere. You'll find us in everyday names. But I do agree prospectively that the relative value is going to be in the small and mid caps. You look at the large cap indices, which have had a nice run in 2023, third year presidential cycle, but trading over 20 times forward right now. Maybe the E is a little low. Maybe we'll get some expansion in the E, but no matter how you slice it, the ratio is a little bit rich. However, when you go down to small and mid caps, you got 13, 14 times forward, and there's a tremendous amount of opportunity there. And we, to your point and astute observation, are trafficking in that space.
I did use the word asymmetry. I think asymmetry often tends to be more along the sides of loss asymmetry, is given the way that distribution and tails work when it comes to equities. What are some of the more asymmetric bets that you're starting to pay attention to entering the new year? Meaning, do you think that there's going to be still a lot of upside asymmetry when it comes to tech names? Are there going to be some new leaders? Talk through your view for next year.
Yeah, I think that we're moving into a new regime, which is dollar has been trending lower, bonds have been trending higher, and usually that coincides with an environment that's favorable to both small caps, as you astutely pointed out, but also emerging markets and ex-US. And if you look across the valuation metrics ex-US, they are attractive. Now, the other side of the argument is people will say, well, ex-US, emerging markets, Europe, et cetera, they've been cheap for a long time. They've underperformed for 15 years. Why is it going to change now? And that's a reasonable argument. I do think that there are catalysts in place. We've been in a very unpopular space for the last year and a half, which has been pure dead money for one of our positions, which is China. Everyone's hated that. They've continued to hate that. I think with now the Fed stepping out of the way, you're going to see an environment that's more favorable, certainly to emerging markets, which have already started to take off. But I do think the catch-up trade will occur in China. You basically had the patient had a heart attack. They've been locked down against their will for 3 years. It's going to take them a little more than 11 months to come off the operating table and start running marathons again. But we are seeing some signs of that in recent weeks, and I think that will be a key theme in 2024. And that's contingent upon the dollar's continued weakness and yields staying compressed, and if not moving even lower, or bonds moving higher. So I think those are some spots that there's real asymmetry because there's no positioning for it. I mean, we saw coming into year end. If you look at the monthly Bank of America Global Fund Manager Survey, managers had the lowest risk in their portfolios since the 2009 Great Financial Crisis lows. I mean, you can't make this stuff up. They had the least risk in their portfolio since the pandemic lows, when we didn't know when or if we would ever have a vaccine. And that's really where the mindset was on a measly 10% pullback in October of this year. So while we've moved a tremendous way in a very short period of time, Michael, it's very, and everyone now is positioning for the 5 or 10% pullback in Q1. That's kind of uniform mindset right now, and we may in fact get that because we did have a similar uniform mindset in July before we got the pullback in August and September. But it's very hard to short all-time highs, number one, and number two, we've gone through a 2-year consolidation. We've effectively had 0% gains in the S&P 500 since 2021. So this just starting to break out kind of reminds me of the last 3 times that's happened, when you had a 2-year consolidation from late 2018 to 2020. And you finally broke out in summer of 2020, 2015 to 2017, which is the last time you had a debacle in China with crazy stuff happening and everyone hating China. And then you broke out for another 2 years. And then similarly with the European debt crisis, 2010 to 2012, you consolidated sideways after the big move off the 2009 lows. And then you rallied for another couple years. So I think this is another garden variety 2-year consolidation, and while 2024 is not going to look as good as 2023 from an index chasing standpoint, I do think there are going to be more opportunities under the surface in 2024 to make a lot more than the indices, which will probably do high single digits to low double digits if history is any indicator, than the indices themselves, which implies that the Magnificent Seven will do okay, but less well. And the other 493 stocks that have just started moving in the last few months, for the most part, is where you'll find excess return.
Yeah, there's a lot in what you said, which I agree with, and which I've lived as a portfolio manager. The emerging market side and the international side in general, to your point, in the last 15 years hasn't done anything. I called it volatile cash, right? Just a whole bunch of sideways, not going anywhere.
Yeah.
And it's been maddening, right? So, I mean, I have a mutual fund that's designed to play risk on, and part of that opportunity set is emerging markets. So you're talking about whipsaw risk. It's been horrible the last decade plus. Now, to your point, anything that's international really does need a secular downtrend in the dollar, right? I mean, a large part of that weakness and home bias, which has benefited investors, has been because the dollar has been in a secular bull, right? Really since 2012. I guess the question is, is there really a possibility that the dollar can enter that long-awaited secular bear? I mean, people have been calling for that for a long time, and when you look at other countries, their setup seems to be worse from a monetary policy perspective than here in the States.
Yeah, I think it's going to be relative Fed policy, relative central bank policy. So it looks like we're going to be the first to ease generally. I know there are a lot of cuts going on around the world, but relative to the major currencies, when you think about the yen, when you think about the euro, maybe even the loonie, not that anyone cares, but I think that's really going to be the name of the game, is who's easing first. And then on that basis, I think there are a lot of similarities. If you've probably picked a theme, I'm really honed in on emerging markets and small caps. And probably just as well as I do that the last environment that set up for excess returns for both of those categories was 2003 to 2007 after tech came off the boil a bit. I'm not calling for any type of massive tech correction. I think we actually had that in 2022. But I do think there are a lot of similarities in terms of dollar weakness coming off of excess strength, in terms of demographics in emerging markets, in terms of small caps relative underperformance, values relative underperformance that we did see in that 2001 to 2003 period before you had a 485% rally in emerging markets in China. You had one of the best excess return periods for small caps in history. And I think conditions are aligning for the possibility of a rhyme, maybe not a recap, but a rhyme for sure. And I'm not of the view that we necessarily need a secular bear in the dollar. I think more than anything else, we just needed it to stop going up for one, and that kind of put a floor in. And now, if you get a sideways to a trend lower, then moving forward, we're going to just be focused on earnings, the recovery. We're going to keep our eye on commodities, which also, by the way, kind of puts an interesting twist on this disinflation story. The spread between the Fed's dots of 3 cuts in 2024 and the market's estimates of 6 cuts in 2024. I do think that you may see, as a result of the emerging markets recovery, and I keep saying emerging markets, but I'm really pointing to China because it's over 30% of the weight, that commodities might find some renewed buoyancy after the first quarter of this year, which will, I wouldn't say surprise, but prove the Fed more correct than the market, in the sense that I would take the under on 6 and maybe the over on 3, so we get to kind of a 4-cut, back half loaded environment, due to the fact that commodities are more resilient than most people think, largely driven by the demand from China that has virtually been non-existent or subdued for the last number of years, and we've almost kind of written them off when that's probably not a wise thing to do when the bulk of their younger population is on average about 34 years old. And if you look back over the last 100 years, it's very hard to find any country or environment where the bulk of the population was 33 to 36. And from that age through age 40, that they didn't have a robust economy and in most cases robust equity market as a result of that, and then abruptly halted as they approached and exceeded age 40 in bulk, in mass. We saw that certainly in Japan in 1989. We saw kind of remnants of that or similarities to that in 2000 and 2009. And I think right now, our millennials, 33, 34, people talk about roaring 20s because of this or that. I think it's simply because of housing and family formation. I do think we are halfway through, an 18-year secular bull. Probably goes to the end of this decade, and any 10, 20, 30% dips are to be bought. And then we'll reevaluate when those folks get to age 40 and stop spending and starting families and that type of stuff, when we'll be in a more subdued environment like we were from 2000 to 2013.
I do think that's one of the stories which is underreported in the fight against inflation. It's more than just Fed policy and the lags. It's that China was not a big driver of commodity prices because of their own deflationary pressures. So the cost push inflation side has been, I think, far weaker than most thought at the start of the year, and that really helped with that deflation. To your point, if China were to somehow reaccelerate, and I say somehow purposely because there's a lot of challenges there too.
Yep.
Then you're right. That does complicate the Fed inflation fight, and maybe that brings into light a discussion around another wave of inflation. You see all these charts that overlay the trajectory of inflation the last couple of years in the early 70s and then how it picked up again. What's the possibility that China doesn't reaccelerate? Because the reality is their debt load is enormous.
Yep.
It seems like they're willing to let the real estate side implode. By the way, I agree with you. I think China is an interesting place to start here just as underinvestment broadly and as a price for everything. But there are real headwinds for the argument that China suddenly is going to pull growth higher.
Yeah. No, I agree. I mean, it's interesting, when I talk to folks, they say, well, China's in a housing crisis. And I say, look, I've been doing this for quite a while. I can't remember when China wasn't in a housing crisis, and I can't remember when it wasn't at the acute point when it was all going to blow up, and we were going to realize the emperor had no clothes in China. So maybe this time is different, and maybe this will be the one. But betting against that has been a good bet, particularly in a weakening dollar environment. And actually, if I take a secular view, I'm not bullish on China for the long term. Unlike most people think it's going to overtake the world, et cetera. I think this is the last. I think they're going to have one last parabolic run over the next 3 to 5 years, driven by that bulk of population, 33, 34 through age 40, and then it's game over for China, and it'll be another Japan. It's a xenophobic society. They don't have much immigration, and they don't have the birth rate, and the policy leaves something to be desired. That's not to say that couldn't be changed, but or will be changed potentially. But I think we're late cycle, and I think that you get the biggest gains in the shortest amount of time in late cycle, and I want to participate. But that said, China is China, so we're expressing it through a meaningful position in Alibaba, because it's the highest quality asset and a relatively low probability of fraud. I mean, people show me great companies in China all the time on paper, and I just won't participate because I need that extra margin of safety that it's proven, it's been around, the probability of fraud is very low, and you can't say that across the spectrum in China. So, you have to be careful, but there are ways to participate that I think you can catch this part of the cycle that seems to be rhyming with the early 2000s, from a small cap, from a dollar, from a bond, from emerging markets, from a China, from a population demographic that can lead to very good things.
And I think all that can be summarized into it's broadly speaking a rotation out of growth into more value style. Right? I mean, the small cap indices tend to be more value based on the sector composition. Yeah. International tends to be more value based on the sector composition. Growth is growth because of sector composition, because of tech.
Yeah, I agree with that. And look, I mean, famous last words, right? I mean, we still own Alphabet from, we bought last fall when no one wanted it. We still own some semis from last fall when no one wanted it. We still own Amazon. But we own it in the context that we're expectant that they will perform but underperform, and we still want exposure. And we do think conditions are right to have some excess performance from the groups that you just pointed to. And I think we will. And I think we're seeing the beginning of it. And, when you look at small cap relative to large cap, whether you look at value relative to growth, these are extremes. And whether we do that on a kind of bucket basis, I'll give you an example. PayPal, okay? This has become a value stock. The new CEO, his name is Alex Chriss. This is a relatively new position for us. It's up 23% off its recent low, but that means nothing. Everything's up in the last two months. So Alex Chriss came from Intuit, and he was responsible for the small business unit at Intuit, which was 50% of revenues. And over a 12-year period while he was there, the stock was a 35-bagger. And in English, that means, for everyone listening, if you put $1 million in, 12 years later, you had $35 million. Or if you, in smaller figures, if you put $100,000 in, which a lot more people could do, you'd have $3.5 million, which is very meaningful in a 12-year period for a lot of people. So he's just come in. It's his first quarter. He kitchen sinked everything. And he basically said, we're going to turn this from a value company back into a growth company. And what does that mean?
Well, it's trading at 12 times forward earnings. It's historically traded at 30 times forward earnings. So why has that happened? Why has the company been derated? Why did the stock go 85% from peak to trough? And the answer is they did some acquisitions, some accretive, some non-accretive, but one of which was called Braintree. Braintree is the non-branded version of their platform that does global processing for large enterprise. So they have Ticketmaster, for instance. Many people have heard of Ticketmaster. Uber, they have Uber's account. They basically have $500 billion of the $5 trillion global processing for large global enterprise. That's the good news. The other good news is their processing volume has been going up. And the beauty of being in the processing business is you get paid on nominal terms. So, above trend inflation is not a bad thing. And the bad news is relative to the PayPal and Venmo branded stuff that you and I are used to as a consumer, which has very high margins for PayPal, the global enterprise business has lower margins. And as that business grew, the overall margins came down because they were getting more volume, more cash flow, more everything, however, at slightly lower margins. That's the bad news. So they derated the multiple. And basically what we've seen in the last quarter is that's starting to reaccelerate. It's something that Alex Chriss, the new CEO, has emphasized, that he believes the value proposition now supports pricing power. They're going to see margin inflection. They've got 435 million people, 435 million users. They've been firing non-profitable users in Latin America. He's committed to growth, but only profitable growth, not growth at any cost, not margin decelerating growth. And I think over the next couple of quarters, when the market sees that, this value stock trading at 12 times is going to start to get re-rated to a growth stock multiple. And you'll have a business that's already, by the way, generating $5 billion a year of free cash flow. And by the way, buying in $5 billion a year of stock, rather than trading at 12 times, start to trade up to 14 times, start to trade up to 16 times. And if he can pull together a few of these levers that he outlined in the last earnings call, I think over the next 12 to 24 months, you could see a 16, 18 times multiple with growing earnings. And that puts this in place to, yes, be up 50%, but maybe a double over the next 12 to 24 months. Obviously, this is all opinion, not advice. I'm sure you always disclaim everything. We don't know your financial situation, but we have a position in it, and that's why we have a position in it. So I think some of these stocks that were either former growth that have become value have an opportunity with the right catalyst to become growth again, or those value stocks that have been left for dead start to get attention. So a good example of that, if you think about the small cap index, is what? Is a lot of banks and a lot of energy. Both have been left for dead in 2023. So why did we have the mini crisis in banks? Part of that was due to, well, the government basically jammed the American consumer with trillions and trillions of dollars of cash during COVID. They all decided to put it in the banks. The banks had to put the money to work at the exact wrong time in history when money was basically zero. They could get no yield. So they said, oh, we'll be safe about it. We'll just put it in U.S. Treasuries. Well, there you go. The government forces them into U.S. Treasuries, or the Fed rather. And then guess what? They have the most precipitous, most aggressive hiking policy measures in the shortest period of time in history since the early 80s. And it sends all these banks upside down. So they have all these unrealized losses. I think what you're seeing now with the bonds starting to rally, which, by the way, it's so interesting. Since summer of 2018, you had never seen a period where more hedge funds where hedge funds were more short long bonds than summer of 2018. And if you look at the chart, that was the beginning of a monster rally in treasuries. Same thing happened this summer in August. We talked a lot about it on our weekly podcast, which is called Hedge Fund Tips with Tom Hayes. It's top rated in the hedge fund category, which albeit is a narrow category, but we're happy to be close to the top. We'll take what we can get. And we've been hovering back and forth between 1 and 2 there. I don't know how exactly they calculate it, but You can find it on YouTube or in your podcast. But we've had this rally in bonds, and we think that that will persist, and that's going to help banks, which helps small caps, which helps ex-US, because a lot of the undervaluation of ex-US is because of the composition in the indices, and you pointed to it before. We're tech weighted, and European Union doesn't really have any tech behemoths because they overregulate everything, so they're stuck with a bunch of zombie banks, and that's why the multiples on their indices are so low, because that's the largest weight in their indices. So I think I said a lot there. I've been up since 2 a.m. I had CNBC London this morning. I'll turn it back to you.
Just reset the room for the remaining 20-25 minutes. Everybody, please make sure you follow Tom Hayes here on X. If you want to come up and ask questions, click that bottom left mic request button. And as always, this will be an edited podcast under Lead Lag Live on Apple, YouTube, and Spotify. Congrats, by the way, on having the energy level that you have, given that. Again, a lot of things I agree with. I had brought up that point earlier in the year that to save the banks, you need to have treasuries really run hard. I initially thought that would happen from a credit event to force like a safety trade, which obviously we haven't seen. I still think that's coming, that we're still in that lagged window from the fastest rate hike cycle in history. But clearly, to your point, the healing that's been happening in treasuries has helped heal the asset side of things for the banks, which goes back again to value. I want to switch the conversation to sentiment.
Yep.
Because I have to tell you, I am legitimately blown away by how fast the sentiment changed.
Yeah.
Now, I myself was wildly bearish. Basically thinking, we were on the verge of that credit event entering November, ended up being the bottom, right? Everything ripped higher, egg on my face on that, although treasuries ended up doing way better than equities, so it's fine. I don't mind being long and bearish by being long treasuries, even if stocks are rallying and I'm wrong on that thesis.
Yeah.
But, and it's funny, I kicked myself because, back then at the end of October on X, what was trending was Black Monday. I mean,
yeah,
it was, a lot of people, which was not just, joking, I said that's partially because I was so loud about it, but the reality is, there was a lot of dark sentiment. I kicked myself for not seeing that as a contrarian signal even against myself, right, with hindsight.
By the way, it's interesting. I actually talked about that article in the Wall Street Journal. We did an article on the website, hedgefundtips.com. We put out a free note every week. But we also talked about it, I think it was on Fox or one of the stations. And I said, this is a pretty bold call by a couple academics that have never managed money, because they've only got 2 Mondays left in the month of October to get it right. And they were trying to be Paul Tudor Jones. The problem is they're not Paul Tudor Jones. And, I would say I totally understand and appreciate the lagged effect argument. And that may prove out. There's no question that that's a possibility. The one thing that I keep coming back to, particularly what else was trending, was the largest contraction in M2 money supply since the Great Depression. Therefore, we were going to have a Great Depression. The problem with that is, if you look at the long-term trend of M2 money supply, yes, huge contraction, except for the fact, so it was $4 trillion above normal growth trend, above the normal long-term growth trend. So it contracted about $2 trillion. We're still $2 trillion above the long-term trend. So we're not even remotely back to trend. And I think that's what's offset a lot of what would normally be the lagged effect of a tightening cycle and a material slowdown, is because that liquidity is still sloshing in the system, and it's going to take some time to digest all that. And it's very hard to digest all that when they're spending like banshees going into the election with the Inflation Reduction Act and everything else that's happening. So, it's a push-pull, but I definitely understand the arguments on that point.
But I think we are now at the other extreme of that, right? I mean, everyone is just declaring, from what I've seen at least, it's a bull market. We're going to keep on going higher and higher, and all that could be true. But I'm the loudest one in saying past matters more than prediction, right? You can have a credit event and then the higher highs afterwards. I mean, that would not be uncommon in history. So, is it surprising to you to see just how, and this is just my own personal opinion, how one-sided we've gotten all over again. We were one-sided bearish at the end of October. I was part of that. I was wrong. But now I'm seeing the exact opposite. And I always go back to the one commonality across major tops and major bottoms is overconfidence.
Yeah, no, look, I agree with you that, we all know the big public folks that were out there since last October, not even just this October, but last October, and they've kind of said, okay, it's the Fed's fault, we're going higher. And they did these big about faces. The only thing that I would caution of, just from doing this for a long time, is after you come out of what I refer to as a heart attack, and I would say last October was kind of like a heart attack. The COVID lows were kind of like a heart attack. The great financial crisis was definitely a heart attack. That first overbought extreme where everything is overbought, whether it's the National Association of Active Investment Managers, the fear and greed, the put-call ratio, option skews showing scary things, whatever metrics, percentage of stocks above whatever moving average, bullish percent of stocks, bullish percent of sectors. There's hundreds of these things. They're all saying it's overbought. In a sideways market, those are damn good indicators to get short. In a market that's coming off of a heart attack, what's overbought tends to stay overbought. And this environment reminds me a lot of summer of 2020, after you come off the COVID lows and had a monster rally. I think it was like, I'm making this up, but it was like 40 or 60% off the bottom in a few months. Same thing with summer of 2009, 40 or 60% off the bottom in a few months. And every single indicator was bearish because everyone was bullish, right? Or everything was at an extreme. And it just kept going. And I think, two of the things that I've been looking at is I really like the Bank of America Global Fund Manager Survey. If you look at sentiment right now, it's come up a lot in the last 2 months. This is from a week ago. But it did the same thing off the COVID lows. It did the same thing off the great financial crisis lows. It did the same thing off the tech wreck lows. And it's only about a third of the way up. And what I worry about is that we all get kind of a little cute with all of these things that help us in normal sideways market. I think the trick of technical analysis, and I'm not a CMT, is that there's not perfect symmetry due to the fact that the market trends up 70% of the time. So the signal that an oversold condition gives is not necessarily, you don't get the same indication on an overbought signal, particularly in a trending market. Sideways market, it can have some value, but the odds are against you 70% of the time. And I look at an environment right now, and there are a lot of smart people in the market, and they're all looking at the same things that we're all looking at, and they're all noticing all the bears getting bullish. And that was a precursor in July of 2023, before we turned down in August and September. Everyone knew it was coming, and it came. So this could be the same thing in January, February. We know February tends to be seasonal weakness. But just looking at even the cash levels at 4.5% in the fund manager survey, you usually don't get topping until it's been below 4% for some time. So yes, you have this year-end chase, and yes, you've had a lot of money, and yes, it wouldn't surprise anyone to get some consolidation or a pullback in the first quarter. And yes, multiples at the large cap level are stretched. But when you look at equal weight, small and mid, there are a lot of stocks still with a margin of safety. Yeah, they've run 20 and 30% off the lows, so maybe they'll pull back 5 or 10% just to scare out the weak sisters and the late money. But it's very hard to get too bearish with margin expansion reacceleration. So the real issue of 2023 was everyone was preparing for a recession that happened in 2022. The first 2 quarters of 2022 was a technical recession, 2 quarters of negative GDP growth, wasn't confirmed by employment, but it was a technical recession.
So what does that mean? It means a lot of these CEOs acted as if a recession was coming. They cut costs, they leaned up their operations. And the story that I think very few people are focused on for 2024 that I've been paying a lot of attention to, yeah, everyone knows estimates are high, and estimates have actually held up so far, 246 or whatever it is, 12% earnings growth. But what people aren't paying attention to are two things. Number one is margin expansion, so 60 to 70 basis points coming of reacceleration in 2024. And with rates coming down, two things happen. Credit markets reopen, so all the companies that had solvency risk or refinancing risk are now going to hit the window, and they're going to hit it hard, and they're going to hit it fast. The other thing that's going to happen is as the year goes on, people are going to refinance at lower rates, which means more free cash flow to buy in stock, which means more earnings power because their cost of capital is actually coming down. So I think these are two items that aren't fully baked into the models that could be a positive surprise. But, I think from an index level, 2024 is a high single digit, low double digit. It's not a 2023. Since 1928, the average returns in a presidential year, 11.28. In a sitting president running for election, it's 13. We've pulled forward some of that. So I think playing the indices is kind of a lame bet in 2024. I think to the point you made early on, looking for that relative value where the multiples are cheap and maybe with value, but not value for value's sake with no growth and a low return on capital, quality value that just happens to be marked down in price.
Which, by the way, everything you said is exactly why I keep saying small caps hold key.
Yeah.
Because the move has been in lowering rates has obviously most benefited small caps because they were most at risk on the refinancing potential crisis, which may still be coming, right? I'd argue that small caps don't break nominal highs, right? And I keep going back to nominal versus real is different. We're still in real drawdown, but that's semantics, you could say. Yeah. But if small caps don't break the prior peak, that would suggest that small cap investors are still nervous that the drop in yield is not enough relative to the zombie company dynamics, right? And that's where maybe there's some higher risk. So it does seem like the interaction of the drop in yield combined with the ongoing concern and risk of small caps are directly tied to the secular argument for whether you're going to have low single digits or positive or negative, I think.
Yeah, no, I think, and by the way, I mean, that's a huge move between where we are today and potentially testing or exceeding the previous highs in the small cap index. I mean, the amount of money to be made during that period in just a handful of regional banks, or even we're not ready to do anything material with oil and gas, but we do like the fact that the group is out of favor and hated once again. It's just price hasn't come down to a level that's attractive. But there are some pure play gas producers that are really interested. And I think we want to start to get some commodity exposure where it's gotten cheap enough because, I actually looked at one of your posts on LinkedIn today. I loved what you put out about the different sector relative performance. I think it was discretionary relative to the S&P, financials relative to the S&P, or small caps relative to? There was
it's right. Every Tuesday there's an overview that's published that shows different sectors, different caps on a relative basis to sort of see where the spreads, what the spreads are telling you. So it's clear, right, that there is obviously an improvement on sentiment related to the domestic consumer, right? Which is really small cap regional banks.
Yeah.
That's really the message there.
Yeah. Yeah. So I think there's stuff to do, and I think there's stuff to do regardless of whether either of our macro views play out. I think on a company by company basis, there are enough decent quality businesses that have been marked down to a level where the margin of safety is great enough that even if your worst case plays out or my best case plays out, the bottom line is they're cash generators, they're growing cash generators, and all they needed was the Fed to step out of the way to start to get a re-rating and start to grow into what has been their cash flow growth that they've not been rewarded for. And, whether that's a PayPal, which is not a small cap, We had a couple other mid caps that we liked. Generac, which is the most boring company, it got smoked. I mean, it was down 85% when we were out buying this thing and talking about it. It's up 63% in the last couple of months, but it's meaningless relative to where it was and where it could go. And what were the two mistakes? Two things, no different than Intel, which is another one we were in last fall. They overstocked during COVID, so they bought at the wrong price at the wrong time because they thought they'd never be able to get parts again. And two, in the case of Generac, high rates hurt them because consumers finance a $5,000 or $10,000 or $20,000 purchase. They have 75% of the home standby generator market in the U.S., but that's only 5.7% penetration domestically, which is interesting because every extra percent is a $3 billion market opportunity. And in states like Michigan, where they have a lot of power outages and a rickety grid, they have 15.7% penetration. And I think as you look at some of the trends, whether it's climate or whether it's EVs or different demands on the grids moving forward, the demand for these is going to continue to grow and continue to be important, and people are going to need durable. And by the way, their C&I business, their commercial and industrial business is growing 24% a year. So backup for cell phone towers, backup for data centers, that type of thing. So these are the type of businesses. So if the economy went into a complete tailspin, it really doesn't matter. When everyone's power is out on the street, except for the one guy who has the Generac, the next time there's a power outage, you're the second guy with the Generac. And that's why those states like Texas and Michigan, which have the highest penetration rates, also have the highest growth rate, because you don't want to be the only schmuck on your block without power when everyone else's generators are humming. So the more people that buy them, the more people buy them, which is kind of counterintuitive, but we think they've got a long runway and certainly with that margin of safety. So those are the kind of things we're trafficking in and looking for value so that we don't have to be perfect on the macro, because at the end of the day, you're taking probabilistic guesses, based on all the statistical data that you can look at and discern. And it may be right, may be wrong, and there may be something that you don't know when it comes down to macro. Whether we get out a week from now, a month from now, 3 months from now, there's always something. But if a company is a high-quality, durable company that's operated through cycles, that's cash generative, that's temporarily impaired, and you can buy it at 85% off and zero solvency risk, then usually you can weather any of the headline noise.
Which is, in hearing that, my mind goes to the well, if you want to then go to probably from a second perspective, would more be utilities, consumer staples, healthcare, just because they've done so poorly on a relative basis this year. They tend to be high dividend, high quality plays in general, and now they're not competing against the Fed, right, in terms of hiking rates going further. So is it fair to say that the real conclusion on this is that we're going to see a return to focusing more on dividends as part of that quality equation?
It's interesting. So you said utilities, staples, and what was the third one? Healthcare? Healthcare.
The three, healthcare, right?
Yeah.
They tend to be lower beta, higher dividend, more defensive sectors.
Yeah, no, I agree with that. It's interesting that you mentioned that, because so the one play that we made, which was a rate play in September when we were expecting bonds to finally get bid, and sure enough, it took 4 weeks more or 6 weeks more, as it always does, was Crown Castle, which is they trade like a utility. All the REITs trade with rates. So we wanted a rate play that also had a margin of safety as a business. It was down 55%. And we figured if bonds got bid, this thing had huge leverage in it. And it's demand for data is growing, demand for cellular is growing, et cetera. It's been slightly mismanaged because they overinvested in small cell and fiber. And then, a few weeks after, Paul Singer of Elliott came in with a $2 billion investment and said, hello, board, you're fired. The CEO is fired. And how was the play, Mrs. Lincoln? So the CEO stepped down. They are now running a process to explore selling the non-productive small cell and fiber business, and that legacy 40,000 towers is a cash machine that he's going to get leaned down to get back to double-digit return on invested capital, and that'll play. Now, the staples, our thinking is alike. We do have a medical device maker that got sold off with the GLP mania this fall. That's kind of our play on healthcare. We also have a basket of biotech, which has been dead money for a year. It bottomed in March of 2022. It's done nothing since, and now it's taking off and actually working to break out of that range. Kind of looks a little like small caps. It had that crash and then a long sideways range for a couple of years, and now it's knocking on the door. I think small caps just peaked above their range, so we have a play that way. As far as staples go, I haven't found enough that have come down to a level where a lot can go wrong and I still make money. They're kind of at the level where it's probably good investment here, but there's not enough safety for what I don't know to go wrong and still make money. So I haven't found anything that I love there yet. I'm just trying to look. One was Kraft Heinz. We have a tiny little position. It got flushed, I think, in the fall. But I do like some of the discretionary names that you pointed to that have been left for dead. We're starting to look a lot there. And healthcare, we only really, besides that medical device, we have a basket of biotech. And I think that's kind of it. Utilities, we didn't really find anything we liked. We looked at Dominion for a little bit and kind of took a pass. So may have missed some opportunity there, but I'm perfectly okay with errors of omission versus errors of commission, right?
Very well said. Tom, as we wrap up, for those who want to track more of your thoughts, more of your work, where would you point them to? You mentioned the podcast. Maybe you mention that again as well as your website.
Yeah, that'd be great. So hedgefundtips.com, that's where people can reach out to contact me. There's a contact form. And then in the weekly podcast, which is called Hedge Fund Tips with Tom Hayes, you can just put it into YouTube and it'll come up as a video, or anywhere you get your podcast, it'll come up as an audio. We do a section at the end called Ask Me Anything, where people submit companies we want them to look at that they want me to take a look at, and I kind of go through some of the financials. Obviously, it's done in real time, so it's a few minutes. It's not a thorough, comprehensive analysis, but it's enough to lead them in the right direction or save them some time. So that's that. We also post the weekly research note on Thursdays along with the podcast on Thursdays. So if you put your email in there, you'll get those every single week. And then other than that, I think it's pretty straightforward. At Twitter, I'm at Hedge Fund Tips, and same thing at TikTok, which is, believe it or not, where a lot of people find me. It's at Official Hedge Fund Tips. And I'm sure there are a bunch of fake accounts there too, but it's the word at Official Hedge Fund Tips. But thank you so much, Michael. I've never done a space before. This was a lot of fun, and I appreciate you inviting me on to do this with you.
Again, everybody, please make sure you follow Tom. I have another space literally in 7 minutes.
And we're back, so thank you for that, Michael, for that. Experience was wonderful. And here we are, back to the future. The last shall be first with the asset quilt of total returns for 2023. And what we like to look at, two things I found interesting. So the worst performers were commodities, treasuries, which, by the way, did finish the year, it looks like, positive. If you remember, we said it's been 48 years since you had 3 years of negative in a row. And I said, I'll take the over. I'll bet that they're not going to wind up negative. So here we are. We came from treasuries being the most shorted since 2018 by hedge funds in the hole, right before we had the monster year-end rally in treasuries, just like we had in 2018, 2019, the last time hedge funds got that short. We anticipated that, not on a crystal ball, but based on structure and positioning and sentiment, as we do with a lot of the positions. and fundamentals. And sure enough, that played out. Then emerging markets, and then REITs. So all of these are areas that we want to focus on in 2024. This is the Bank of America buy, bull and bear indicator. This is in line with how I'm seeing things. Some of the indicators are pinned to bullish, so I'd be cautious. But there are enough that matter that are saying we may not be there. You know, consolidation would be normal. I'm not going to repeat what we just went through, but I wouldn't get too cute with it. So in addition to some of the names we've covered above, we'd like to look at sector performance by year, despite the final column being improperly colored. They didn't match the colors. It must have been a new person because it was done at the end of the year during holiday season, probably a intern or something like that. But you can see in previous years what is at the top in previous years tends to trend down, while what is at the bottom tends to trend up in the following years. So you can see, you know, emerging markets went from the bottom to the middle to the top. Same thing here. So that was from 2018 to 2020. Then same thing from 2015 to 2007, went from the bottom to the top. Same thing from 2002 to 2004, from the bottom, or 2002 to 2003, and then stayed at the top for 4 or 5 years. I think we're going to be entering a period, because we had this period where emerging markets stayed at the top for 4 or 5 years, then it stayed at the bottom for 4 or 5 years. I think we're going to go back to a period where it stays at the top for 4 or 5 years, driven by China. Very non-consensus view there. And this year, in addition, to many that have underperformed, in many cases, we are ahead of the curve with treasuries. We did this fall, emerging markets with Alibaba, and REITs, VNO. We already booked the double on Vornado, and CCI is already up some 30% off the low, so we were ahead of the curve. We do want to get some commodity exposure, which is consistent with our view on emerging markets recovery. That's where this name comes in. We alluded to it last week, Comstock Resources, and we've also talked about it, over a year ago, because in some accounts we actually in the last week brought our basis up, which we never do. But we got lucky. You know, this thing pulled back enough where it makes sense for us to load up to existing accounts and get new accounts where there's capacity, some exposure. And this may come down a little bit more, so we'll be able to build out the position over coming months. But this shows you the Comstock Resources, and it shows you natural gas. So added to new accounts and take up our basis. Now, Jerry Jones, the owner of the Cowboys, who made his initial fortune in oil and gas, owns 65% of the company at about $7 per share basis. He has stated in his public interviews that his oil and gas interests are worth well more than the Dallas Cowboys. We agree. And you can see here in the proxy, he's got 182 million shares through his different entities. And with the proven reserves, PV10 value at $15.5 billion and an enterprise value of $5.1 billion, this implies that that if the company was liquidated tomorrow, you would have a triple. But that excludes the unproved reserves, which are estimated at an additional 15 years of inventory beyond the PV10 reported to the SEC. In English, that means the company likely has an intrinsic value somewhere around $60. It's just a question of how long it takes to realize that value. Given that Comstock has among the lowest cost of production in the industry and access to export through the Gulf of Mexico, the value creation story is just beginning. With natural gas prices currently in the doldrums, we will likely have some time to accumulate an even larger position over time. So we're going to go through some of these bullets. You can read them at hedgefundtips.com. And then we're going to get to the Ask Me Anything questions and get you guys off to your New Year's celebrations before you come back on Tuesday and hit the ground running. So why invest in Comstock? This is from their pitch deck: direct access to high-value Gulf Coast markets in the LNG corridor. Industry's lowest operating cost structure drives top-tier margins and return on capital employed, even in lower natural gas price environments. So while others would be having liquidity issues, they are taking share. And and strong balance sheet created in 2022 allowed for the reinstatement of the quarterly shareholder dividend. So you get, I think, over 5% dividend yield while you wait for capital appreciation, which is mind-boggling in this environment. And then finally, strategic relationship with successful Dallas businessman Jerry Jones, largest shareholder whose investment to date in Comstock is $1.1 billion. So I got 470,000 Haynesville Bossier net acres, substantial upside in Western Haynesville extension, industry's leading high margins driven by low-cost structure, access to premium Gulf Coast, robust inventory of de-risked, high-return drilling locations, 1,491 net drilling locations, average lateral length 8,900 feet. They've got some that go as much as 15,000 lateral feet, and proved reserves, PV just of 10 years, 15.5 billion, trading at an enterprise value of 5.1 billion. That's really all you need to know about this story. They just got this group, Quantum Capital Solutions, which is a respected capital provider, to put up $300 million to expand into Western Haynesville mainstream. So they'll get a preferred distribution of 80% until they get their money back, and the hurdle, then it reduces down to 30%. So it's a low capital way for Comstock to get great benefits down the road. You can see the laterals here, the reserves here quantified, and then their cost structure, 40% lower than peer average, which is mind-boggling. You can see it right here. And even with interest payments, still 27% lower than peer average. So they can just outcompete them. I went through word by word the earnings call. The key thing here is I was shocked at their financing. Their balance sheet is so clean. They've got low cost of capital, not maturing. Their revolver, which is $350 million they've got drawn, doesn't come due till 2027. And then their long-term debt is towards the end of the decade, and it's at like 5.5% and 6.5%, which is mind-boggling. It's just very exciting, and they can draw $1.8 billion off their revolver if they have to. So they've got no capital problems, low cost of production, unlimited inventory of acreage, and thank God for the low prices. We got a chance to build that position and initiate that position for a lot of accounts. So we're pretty exciting. So, all right, so here they are. Balance sheet at the end of the quarter. We ended the quarter with $345 million of borrowings outstanding under our credit facility, giving us a total of $2.5 billion in total debt. Our $2 billion credit facility giving us a total of our $2 billion borrowing base was recently reaffirmed by our bank group this month, and we ended the quarter with financial liquidity of almost $1.2 billion that they can draw on, which is exciting. They talk about the new deal with Quantum, which is a great deal that they structured, capital light, very few restrictions. And they anticipate growth in LNG exports beginning to show up the second half of 2024. So we're going to have like 6 months to build a really nice position, unless the price starts to take off. If we get a, what are they talking about? An Arctic freeze or some Nino thing that they're worried about. Like, anyway, in English, that means really cold weather coming. We'll see. That's going to, the partnership with Quantum is going to reduce CapEx that would otherwise be required to support the growth of their industry-leading lowest cost structure, etc. So you can go through these on your own. I just want to touch on the key points here because it's a pretty long call and we've got a few Ask Me Anything questions. Not only did they get $300 million for the expansion, they can expand with additional approval up to $500 million. So they're just in this beautiful, perfect position with global demand going up, with exporting abilities going up. I think I like how energy is getting hated right now because I think that people are underestimating the recovery in emerging markets. maybe a little geopolitical noise in the early part of the year, and all these things are going to put a bid. I just don't think any of the E&Ps have come down enough for me to want to commit new capital, but I do love some of these pure play gas companies that we've talked about, and now we're specifically talking about Comstock because it makes sense for brand new money. So they generated $167 million cash flow from operations in the quarter alone. That's 60 cents per share. What else do we want to cover here? Their production actually went up, even though their cash flow obviously went down because of the price of natural gas. So they're just more and more efficient, still profitable, still generating cash at really suppressed prices. These are the times you want to get in. This shows the capital structure. I was saying 6.25% senior notes due in 2029, 5 1/8 senior notes due in 2030. And the revolver, they've only got $345 million drawn, and that's SOFR plus 175 to 275, maturity date 2027. So that's pretty exciting. You can see it here. I've never seen a more beautiful balance sheet. I mean, they hit the window because they looked the devil in the eye in 2018. And once the game was back on, they knew what they had to do, which is just perfect. You can see all their properties here. And lowest cost structure, liquidity, and the dividend of 12.5 cents a quarter, which is 50 cents a year on a $9 stock. That makes a lot of sense. So almost 6%, which is pretty exciting. Sentiment obviously stretched still, can stay stretched. You see this coming out of these type of things, just like we did in COVID. Everyone said, here, we're going back down. We kept going up. You can see it back again in 2015, 2016. We've covered this ad infinitum. Could we get some chop in Q1? Yes. Would I overplay my hand on that? No, because you might just wind up giving up some great companies that keep running. S&P earnings, top 30 weights last 60 days, actually revised down 1.74%. I'm looking through this just to see if it's skewed to one company that's driving it. AMD, that's a big hit. And then Chevron, looks like mostly AMD and Chevron. That's skewing it. Vago took a big jump up, and Meta. So like I said, Meta, $2 down. That's kind of interesting with Meta because that would support a more subdued general indice return, high single digits, low double digits, and a real galloping opportunity under the surface. And as such, the Russell 2000, the small cap index, top 30 weights in the last 30 days, revised up 1.86%. So that tells you what we've been talking about. Ask me anything questions. Rob Notaro, looking at Nutrien. Okay, let's take a look. NTR. I do like this. I've had my eye on FMC for a while, but it kind of got away from me, and we have enough positions. I don't want to get too diluted, but I like the space. Let's take a look at this one. So it's down from 110 to 56, so it's kind of split in half. Let's take a look. NTR. All right, I got to make this smaller so that it all fits. Nope, smaller so that it all fits. Okay. So revenues have dropped off quite a bit in the last 12 months, and EBITDA's half. So, I mean, it makes sense that the stock's down. What's happening to cash flow? Yeah, I mean, it's all off. So you basically have to get on and do your work about free cash flow. Yeah, it's all cut in half, and so has the stock. So basically what you're playing for here is you're playing for the recovery story, and management needs to do a good job of selling that to you. Why is this a temporary impairment versus a permanent impairment? $500 million of cash, a lot of debt. So you got to find out when that matures. This one is not good enough of a business for me to get interested to do more work. It might work for a trade, but I'm going to pass on that one, Rob. I do like your thinking and going way, and it might very well work, but it's a pass for us. Let's take a look. Jason Patel has got, okay, Coley, China overseas land and investment. I will never buy. It's a tier 1 and tier 2 developer. I will never buy a smaller mid-cap company in China. There's just no way to tell whether its numbers are correct, and I'm not going to take that gamble. So we've covered that before. For me, I look for, it's the same thing in 2020 when oil traded negative and we were looking for energy companies. We bought Exxon. I mean, you don't need to double your risk. You know, when we bought commercial real estate, the most hated area, we bought the best properties in the best city in the world in Vernado and doubled our money. So why would we traffic in that stuff? It's just gambling. You know, it could have the best numbers on paper. You wake up one morning, it's a fraud. Like Luckin Coffee went bankrupt, even though the business was good, the numbers were fudged, and now Luckin's off to the races, but you lost your equity before you gained it. So if you bought it in the reorg, you made money, but you don't want to be part of the reorg, and that's why I'm going to pass. Philippe Vakurkiek. Okay. He wants to know about how I size positions and weighting and all that stuff. So I can't give you advice like that because I don't know your financial situation, and that's proprietary to our money management clients. But I can say generally, you're not going to outperform if you own too many stocks. So we like to have 8 to 12 ideas on and companies on at any one point in time with a large margin of safety, cash generative companies, growing cash flow, temporarily impaired price. And then we'll often do a smaller portion of the portfolio, long dated derivative overlay for excess returns without having to take much leverage. And that's how we think about it. We do overweight our highest conviction or best value ideas relative to price. But we have limits on that as well, so which we've alluded to in previous things. Nolan, if you're serious about studying that and learning how it applies to you, level 2 CFA books are worthwhile read. Nolan Fernandez, longtime listener, love the show. Uranium is likely a top commodity performer in 2023. Too late for build out small mic. Cameco and NextGen have already had run-ups. I don't play Cameco. I don't play commodity stocks other than energy when the odds are dramatically in my favor. All the others just seem to be failures, whether it's gold or uranium or any of that stuff. They're trading stocks for trading junkies, but you don't make real money over time, and you'll lose more than you gain. So pass if you want to play that. You know, we still have a tail on Range Resources, but we took it off most of the position at 3x. We kept the tail on. Same thing we did with Intel. Okay, we believe in the SMRs. We believe in the plan to generate 50% more cash than they ever did in 1 year over the next few years. But we can't bet on that, so we'll bet with the house's money. That's why we kept a third on. Same thing with Gelsinger. We think he's going to definitely fulfill it, but we're betting with the house's money after we took our double off. So and kept the third on to run with the promise of Manana versus we got in for the guaranteed of the airline engine service hours coming back in the case of Rolls-Royce. Now we've got the free option on the SMRs and the international travel and business travel accelerating. And then with Intel, we got full value for the PC and the data center business coming back. Now we've got a free option on the foundry and advanced chips, Gaudi chips and that type of stuff. Kevin Martin, he's asking about Kendall again after I said it's a pass. Look, I think Kendall is fine. The problem is I don't like consultancy businesses because I have no way of modeling it. So Accenture has been a great business. and I missed that, and I'm perfectly fine missing that, because in my view, the assets go down the elevator every single day. It's kind of like the investment banking business. If it's not tied to a bank, it's a kind of a crappy, lumpy business. And there are exceptions. Accenture's an exception, and maybe Kyndryl will be an exception. But coming out of the IBM culture of the last decade, I don't have a fear of loss that I'm losing the best talent in the world by not investing in Kyndryl. So I'm going to leave it there on Kyndryl and stick with my original thing. So generally, if I say that I'm passing on something, asking me the second time usually doesn't get me to change my mind unless you present new information. And two things haven't changed. Number one, not enough history for me. I like businesses that I can see how they've operated through cycles of 1 or 2 or more decades, and management, how they've acted and operated through cycles. And two, I like businesses I can better understand, and consulting is not one of them. Jason Patel asks about Extreme Networks. So let's take a look at that one. It's a smaller competitor to Cisco. Okay, so this one's already run up from $1.50 to $32. It's pulled back a little bit here. Let's see here. Keeps growing top line. It's decelerating a little bit, but still profitable. Looks like it inflected. That's reflected in what's happened with the stock price as well. Let's see. It's generating solid free cash flow. Balance sheet looks okay. And it's just starting to compound capital. This is worth a further dig. For me, you've missed a 15 bagger already. I mean, I don't like to chase these. Obviously can keep running and could have a lot more in it. I'd probably spend some time on it if it got back to $10, but at these levels, for me, it's just not worth my time. I want something when everyone's flushed out. I'm willing to wait, and so I can get, the good middle of the move, the big, fat, juicy part of the meat. You're never going to get the exact bottom or the exact top, but you can get so much out of the middle. So after these things have run, I get less interested in doing the work, because the work, it's hours and days and weeks of work before you can get the conviction to commit capital. Let's just see something here. Software-driven networking solutions. Yeah, so I mean, this is a ton of work, because you have to understand what's their edge. Why are they better than their competitors? Are they gaining share or losing share? Why are they gaining share, losing share? What's coming down the pike? I mean, this is why Buffett has historically avoided tech companies. And to have an edge here, you really need to be a specialist, and you need to be masterful around it. Just on the numbers alone, yeah, it's probably worth a look, but I don't think enough margin of safety is there, given the risk of that type of business, that I want to be aggressively exposed. There are too many simple businesses that are down enough that we can jump on and make great money. So we'll leave it there. In the meantime, I want to take this time to wish everyone